The American dream has long been defined by a simple, unspoken contract. You work hard for 40 years, you contribute to your 401k, you pay off the mortgage, and in return, the final chapters of your life are defined by a hard-earned tranquility. It is a vision of golden years spent traveling, visiting grandchildren, and finally exhaling after decades of the daily grind. But for those currently standing on the threshold of that dream, the view has changed. If you are over 45, you likely feel a growing sense of cognitive dissonance. You have followed the rules, yet the numbers on your screen no longer seem to command the same reality they once did. We are entering 22/6, and the financial landscape for the American middle class has shifted from a predictable path to a complex psychological and economic trap. It is not just that things are more expensive. It is that the very nature of value, savings, and stability is being rewritten under our feet. Today, we are going to look past the surface-level headlines and analyze the structural forces that are making your savings feel smaller, even as the balance remains the same. We will examine why the traditional safety nets are fraying and what the quiet shrinking of your wealth actually means for your retirement timeline. Before we dive into the data that the mainstream financial media often skims over, I want to invite you to join our community. If you value deep dive analysis that respects your intelligence and focuses on long-term stability rather than market noise, please consider subscribing to the channel. It is the best way to ensure you stay informed as these economic shifts accelerate throughout the decade. The current economic environment is characterized by a phenomenon known as the invisible ceiling. For the middle class, especially those in the peak of their earning years or approaching retirement, income may be steady, yet the purchasing power of that income is being squeezed by a pincer movement of structural inflation and asset bubbles. When we talk about inflation, we often focus on the price of a gallon of milk or a tank of gas. While those are important, they are transitory. The real danger to your retirement is lifestyle inflation, driven by the rising costs of non-discretionary services, healthcare, property taxes, and insurance. These are the pillars of a middle-class life, and they are currently inflating at a rate that far outpaces the consumer price index. For someone at 55, a 5% increase in property taxes or a 10% jump in health insurance premiums represents a permanent erosion of their future standard of living. This is the quiet shrink. Your bank account isn't necessarily losing dollars, but those dollars are losing their ability to provide the specific future you spent 30 years planning for. The core of the 2026 trap lies in the distortion of the housing market. For generations, the home was the ultimate hedge against inflation and the primary vehicle for middle-class wealth. However, we have reached a point where the equity in your home is becoming increasingly illiquid and expensive to maintain. With interest rates remaining stubbornly higher than the previous decade's historical lows, the move-down buyer, the retiree looking to sell the large family home and buy a smaller, more manageable property, is finding that the math no longer works. You may have $500,000 in equity, but if moving to a smaller condo results in a higher monthly payment due to current rates and spiked insurance premiums, you are effectively trapped in your largest asset. This creates a stagnation in the market that prevents the natural flow of wealth and housing inventory, forcing many to stay in homes that are too large and too expensive to maintain, further draining their liquid savings. It is precisely these kinds of structural revelations that allow us to move from a place of anxiety to a place of agency. If you are finding this breakdown helpful in navigating your own financial journey, this is the moment to hit the subscribe button. By doing so, you help us continue to produce this level of independent research and ensure that more people have access to the truth about the modern American economy. Beyond the home, we must address the psychological pressure of the 401k era. We are the first generation of Americans expected to act as our own pension fund managers. In the past, the risk of longevity the risk of outliving your money, was held by the employer or the state. Today, that risk sits entirely on your shoulders. In 2026, the volatility of the markets is compounded by a global economy that is deglobalizing, leading to more frequent supply shocks and persistent price pressures. The old 60-40 portfolio, once the gold standard of safety, has struggled to provide the necessary protection against a backdrop where both stocks and bonds can fall simultaneously. For the person 5 years away from retirement, a lost decade in the markets isn't just a statistical anomaly. It is a life-altering event. This is why the stress levels of the middle class are at an all-time high. It isn't just about greed or wanting more. It is the mathematical realization that the margin for error has vanished. The implication for the viewer is clear. The passive approach to retirement is no longer viable. The set-it-and-forget-it mentality worked in an era of falling interest rates and stable global trade. In the current era, wealth preservation requires a more sophisticated understanding of real yield. You have to ask yourself not just what your return is, but what your return is after the true inflation of your specific lifestyle. If your expenses are rising at 7% and your portfolio is growing at 5%, you are getting poorer even as your net worth hits new highs. This is the structural revelation that the majority ignore. Nominal growth is a vanity metric. Real purchasing power is the only metric that matters for your freedom. As we look toward the end of the decade, the pressure on the middle class is unlikely to abate without a significant shift in how we view labor and assets. The reality is that many will choose to, or be forced to, work longer. But this shouldn't be viewed solely as a failure. Rather, it is an adaptation to a world where the cost of doing nothing has become prohibitively expensive. The quiet shrinking of savings is a signal to reevaluate what we value and how we protect it. It requires a move toward diversification into assets that have intrinsic value and away from purely paper-based wealth that can be eroded by the stroke of a central bank's pen. As we approach the end of this analysis, I want to thank you for spending your time with me today. Financial literacy is the only true defense against economic uncertainty. If you haven't already, please subscribe and turn on notifications so we can continue this conversation in the next video. Your support allows this channel to remain a calm, objective voice in an increasingly loud and confusing financial world. There is a certain quietude in facing the truth. While the 2026 middle-class trap is real, it is not insurmountable for those who are willing to see the world as it is, rather than how it was 30 years ago. The path forward requires a sober assessment of your assets, a ruthless pruning of unnecessary liabilities, and a commitment to protecting your most valuable resource, your time. The numbers may be shrinking in their power, but your ability to adapt and strategize remains your greatest asset. We live in a time of great transition, and while the transition is rarely comfortable, it is often where the most important lessons are learned. Stay vigilant, stay informed, and remember that wealth is not just about the balance in a bank account, but about the security and peace of mind you build for yourself and your family.